Shocking new satellite images are. This activity is taking place even though a ceasefire is officially in effect, and President Trump has declared that the war is over with the U.S. victorious. U.S. intelligence reports indicate that about half of Iran's missile launchers survived the initial phase of the conflict, explaining the current efforts to dig them out now. Meanwhile, dozens of U.S. military aircraft have been supplying Israel as both sides appear to be preparing for a possible resumption of hostilities in the region. Experts note that Iran is showing remarkable resiliency by attempting to salvage its military assets even as high-level peace talks continue in the background. The U.S. Navy has been ordered to blockade Iranian ports following the collapse of peace talks in Islamabad, where Iran refused to abandon its nuclear program. Vice President Vance stated that Iran would not commit to giving up its nuclear weapons program, which prompted President Trump to escalate with the naval blockade immediately. This blockade has caused Brent crude to jump 7% to $102 a barrel, as WTI surged to $104 per barrel. U.S. gas prices have risen more than $1.20 per gallon since the war began, reaching a national average above $4 across the country. These latest satellite images and the ongoing blockade suggest that both sides are actively preparing for the possibility of renewed conflict despite public statements of victory. Is President Trump's optimistic declaration that the war is over merely a smokescreen to mask the real preparations happening on the ground by all parties involved? Iran appears determined not to surrender its capabilities easily, as evidenced by their efforts to unearth and restore the buried missile systems right now during the ceasefire. At the same time, the United States is providing substantial military support to Israel, with dozens of aircraft involved in supply missions to bolster its ally. This dual preparation by both Iran and the U.S.-Israel axis indicates that the current peace may be fragile and temporary at best in the region. The collapsed peace talks in Islamabad highlight the deep divisions over Iran's nuclear ambitions, which remain a central point of contention between the two parties. Such developments raise profound questions about how long this apparent period of de-escalation can possibly last before tensions erupt once again into full-scale conflict. The global energy markets are already reacting strongly to these unfolding events, with significant increases in oil prices reflecting fears of prolonged supply disruptions through the Strait of Hormuz. Traffic through the Strait of Hormuz has collapsed dramatically since Iran began attacking tankers, leading to major rerouting and strategic reserve releases by consuming nations. Despite these mitigating measures, analysts estimate a net shortfall of 3 to 4 million barrels per day in global oil supply persisting in the near term. Consumer prices are already showing the impact, with the latest CPI report indicating a sharp monthly increase and accelerating headline inflation rates in the United States. Yet the critical nuance lies in the current economic conditions, which differ markedly from previous oil shock episodes in terms of wage growth and consumer strength. With both sides seemingly positioning themselves for potential future confrontations, the false sense of peace may soon give way to renewed volatility in global financial markets. But to fully understand the market implications of these escalating tensions, we must turn to the latest investment research report, which offers detailed analysis and strategic recommendations moving forward. That report from April 14th lays bare how Iran's desperate digging for buried missile launchers proves the blockade will drag on far longer than politicians admit. President Trump declares the war is over, yet these satellite images expose Iran digging missile launchers from rubble during the supposed ceasefire period. This activity highlights the massive hypocrisy as Tehran rebuilds its arsenal while Washington blockades ports and supplies Israel with dozens of military aircraft. Citi's analysis shows the world economy still confronts a net shortfall of 3 to 4 million barrels per day despite all offsets. As a result, oil prices are set to remain near $100 a barrel for the foreseeable future, according to their models. The report warns that if the strait stays closed, the supply loss could easily double once existing cargoes run out by late April. On the inflation front, the March CPI already delivered a shocking 0.9% monthly increase, the largest since June 2022. Higher energy costs will pass through with a lag, pushing headline inflation significantly higher, while core measures may still appear relatively contained. Unlike the 2022 shock, we face decelerating wage growth, stretched consumer balance sheets, and noticeably weaker corporate pricing power today. This difference could prevent a full-blown inflation spiral, but it also raises the risks of stagflation if growth slows too sharply. The Federal Reserve now sits trapped between its dual mandates as this stagflationary supply shock pushes inflation up and growth down simultaneously. Futures currently price almost no chance of rate cuts with this year, with some traders even preparing for the possibility of a hike. JP Morgan's team boldly recommended equity markets show a curious resilience, with the S&P 500 down less than 1%, while global indices fell much more sharply. Historical data from past oil spikes suggests equities often rebound strongly in the 6 to 12 months following the initial price surge. Investor sentiment has turned sharply bearish, which, according to the report, creates attractive contrarian opportunities for adding equity exposure at current levels. The research highlights that valuations heavily favor international stocks, Europe, and emerging markets over the expensive US market right now. A style rotation toward value stocks over growth names makes perfect sense in the inflationary environment created by these persistent high oil prices. Yet none of these strategies can, with Iran recovering launchers and the US enforcing a blockade, this so-called peace looks increasingly like nothing more than a temporary smokescreen. The hidden agendas on all sides suggest that this deceptive calm cannot possibly last very long before new shocks hit the markets. Corporate earnings season will provide the next critical test as companies reveal whether higher energy costs are pressuring their margins and guidance. How long will markets continue to ignore these on-the-ground realities of preparation for war while politicians sell a narrative of resolution? To truly prepare, we must now examine the forward-looking predictions and specific investment recommendations that flow directly from this sobering analysis. The report lays out precisely how Iran's frantic digging for buried missile launchers signals that this blockade and high oil prices are here for the long haul. Expect energy costs to stay painfully elevated near $100 per barrel, with the very real danger of prices exploding higher if war resumes fully. Inflation pressures will build steadily higher and more persistently as this major supply shock feeds through the broader economy, pushing headline consumer prices significantly above current levels. Unlike the situation in 2022, this time around, decelerating wage growth and exhausted consumer savings mean ordinary families will feel the brutal impact much more directly. Unlike the situation in 2022, this time around, decelerating wage growth and exhausted consumer savings that meant the federal rates and wheat them and 20 delivers a bold call to load up on long-duration bonds, arguing current hawkish pricing ignores the likely path toward either peace or recession. Stock markets may look relatively steady on the surface today, but this deceptive calm will vanish the moment investors finally wake up to the reality of this fake ceasefire. Looking back at history, major oil shocks have typically been followed by strong equity rebounds, delivering solid gains over the next 6 to 12 months. Serious investors need to rotate hard and aggressively into international stocks, Europe, and emerging markets, where cheap valuations contrast sharply with America's dangerously expensive market. Value-oriented stocks, together with small caps and cyclical sectors ranging from energy to metals, are perfectly positioned to thrive amid these sustained inflationary pressures. Meanwhile, many overvalued growth stocks and artificial intelligence names that have already been battered may suffer even more pain as higher energy costs crush their profit margins. Keep your eyes glued to developments over the next 72 hours, because any fracture in this phony peace could ignite fresh market turmoil instantly. The upcoming first quarter earnings season will cut through all the official spin when company executives are forced to reveal how soaring fuel expenses are squeezing margins and future guidance. The upcoming first quarter earnings season will cut through all the official spin when company executives are forced to reveal how soaring fuel expenses are squeezing margins and future guidance. President Trump's optimistic claims that the war has ended serve only as convenient smokescreens, masking the dangerous military preparations that are happening on all sides right now. This entire fragile peace is built on quicksand and cannot possibly survive for very long, with missile launchers being recovered and a full American naval blockade remaining in effect. When the mask finally drops, expect explosive levels of volatility across oil markets, inflation readings, and equities as cold reality crashes back into the financial system with a vengeance. Those who follow the report's advice by diversifying globally, favoring value stocks, and adding bond duration will stand the best chance of navigating these storms. The global economy has weathered many recent crises, but this cocktail of lies, geopolitical tension, and energy warfare pushes its resilience to the breaking point. Hardworking Americans paying more than $4 for gas at the pump will shoulder the heaviest burden, while Washington elites play their usual games. Though the threshold for recession may not be immediate, ignoring these glaring red flags coming directly from the Strait of Hormuz would amount to reckless financial gambling. Act decisively today by implementing these research strategies, because another wave of market shocks is not a question of if, but only when it arrives. True clarity and insight come only from cutting through the endless official narratives and recognizing just how precarious and unstable our current situation has actually become. Analysis: only those clear-eyed investors who reject the hypocrisy and position their portfolios intelligently will preserve and potentially grow their capital when this illusion inevitably shatters.